Oh, another day, another dollar. Yeah, that TWO trade was pretty straightforward, though.
Yeah. There's this chipmunk that comes around. So tame now. We got it. It's like super
Does it
tame.
like sit on you?
Dude, I can pat it and stuff.
No, you can't.
Dude, and like it comes in like licks my ankle when it wants food.
Are you serious?
I swear to God.
Is it like a little chipmunk?
Yeah, it's a little chipmunk.
No way.
Yeah.
Wow.
I got the nuts right here.
Taming the wild.
Taming the wild, man.
Unreal, dude.
How are you doing, man? How's are we live?
We're live.
Nice. Well, let's some people flow in.
We'll let some people hop in here.
How's your day looking this morning, Sean?
What'd you say?
How's your day looking? How's your book looking?
Man, my book is looking okay. I threw on a position on CCL yesterday that it's getting smoked right now, but that's okay. It's not
doing too bad.
To get out of the position yet, but
it's not doing too bad.
I wouldn't go as far as to say it's doing well.
Mm-hmm. It's down. It's in the black.
Yeah, exactly. But it's okay. It's not a big deal. I think I'm waiting for that pop back up. I'm sensing it's gonna break trend and reverse, and we're gonna make lots of money on this one, boys.
You're looking to catch some pips.
Catching some pips.
Yeah, guys, we're gonna break down a few names today. Starting with Boeing.
Yeah, so airlines have been on a tear, down. And so we're gonna take a look at them, right? Like, as option traders, we don't want to be looking at this thinking, let's buy a put or let's buy a call, right? Something that, I was really trying to think of like how to word the difference between what the average person does and what a professional does. And the average person is solely focused on the power that the option gives them. So like the right that it gives them to buy or sell a stock at a given price. Whereas the sophisticated option trader is actually focused on like the value in the option price. So they're more sensitive to the price of that option. And that's really where their focus lies. Right? Because when you do that, like that's where it ends up, that's where you find the actual trades. It's when you can find a mispricing in the actual option price. So we're not too worried that, the stock's moving down right now. We want to take a look at the option chain and go, okay, where is there something that we can take advantage of? So George, you want to start taking a look?
Yeah, definitely. So as Sean mentioned, Boeing's been on a huge tear and now all of a sudden it's pulling back down, right? So, and we're actually pulling down with quite a bit of volatility. I mean, it's down 8% right now. So it's pretty big. But what we like to do is instead of looking at price, we'll take a look at volatility, right? What's actually happening behind the scenes, and we'll try to make a bet on that.
Mm-hmm.
So this is our terminal, and we're looking at Boeing right now. So we can see that the implied volatility is 85% for the 20-day options. So what that's implying is that the market is saying that Boeing is going to be moving on average, 5.5% over the next 20 days on average, up or down. And if we take a look here, well, Boeing's moving 8.5% right now. So we might actually not want to be selling volatility, and we might not also be wanting to buy volatility just because 5.5% a day for the next 20 days is pretty big, right? So this might be something that's like, let's say, fairly priced, but that doesn't mean we can't take a trade here, right? Maybe there's an advantage in trading the sentiment. So what we notice here on Boeing, let's go back to the terminal, is that look at the call skew. Okay, meaning investors are buying a lot of calls on this stock, and they're driving up the demand for the calls relative to the puts. So maybe those are expensive, right? Maybe we can structure a trade where we sell some out of the money options, buy an at the money option to structure some type of trade that's, not really sensitive to the implied realized volatility, but that's sensitive to the skew or the different type of demand. What do you think, Sean?
I think my mic was on mute there. Is that better?
Yeah.
Okay, perfect. Yeah, I think that's good. Let's take a look at things.
Yeah.
Let's go through a couple of them because, You know what? Like a lot of them, they're moving similarly, but there's a lot of them that are different sizes too. So one that I always like to take a look at is Save.
Yeah.
Because you usually get like the retail sentiment, for example, it can drive a lot more skew.
Gotcha.
It gets pretty wild.
Gotcha. So yeah, tons of skew, right? So I think we broke this down in the last one, in the last trade, where if you are bullish on the stock, and I think if we go on stock twits,
Everyone's pretty bullish. It's like
yeah.
75-80% bullish.
So I guess the majority of you here are bullish on SAVE. Yeah, 95% of people bullish. So if you are bullish on the stock, don't just go out and buy the calls, right? You're probably overpaying for them. Doesn't give you a good risk rewards situation. Instead, try to set something up where the risk reward is tilted in your favor, right? So in this
Exactly.
case, we can go SAVE. We could do something like, let's buy the 20 calls. So this is maybe what you would do. You just go and buy the $20 call. And here's what your structure looks like. What's going on here, man? Here's what your structure looks like.
What's happening there?
I don't know. I have no clue. I gotta like restart the Thinkorswim because I guess memory's gone.
Oh
man.
Okay, load that up in the background. We'll go over a couple
Yeah.
more right now, and then we'll hop back in and break down the structures.
Yeah, it sucks. Okay.
Wow, it's 95% bullish on
Yeah,
Save.
95%. Yeah. And you can see that right in the call skew here. I mean, look at that, man.
Yeah. See, and that's the type of stuff that we really want to look for, guys. It's like where our logical idea actually lines up with the data.
Yeah.
Right? Like it's cool how you can see that all sort of fit together. It's like huge call skew, relative actions at all-time highs, which means that it's getting more action trading happening around it right now than it typically does at its highest level. Then you look on StockTwits and you see that everybody's bullish and the message volume's all the way up. So it's kind of like all the things start to align and you sort of have this, it starts to make sense. And then that's when you can really go, okay, I can put some money behind this trade.
Exactly. So this is like, for example, a trade that people would look at, just like buy a call. Oh, I'm going to buy a call. If the stock goes up, I make money. It's not necessarily the case, right? You're very sensitive to volatility. So instead, we want to structure a trade where instead of paying $1.65, maybe we can just pay 50 cents for a trade, right? And get the same type of exposure here. So if we did something like, let's say we did a unbalanced butterfly, which, is our basically go-to for directional trades. We could maybe set up a trade where we're only paying 75 cents. So we just cut that down by more than 50%. And look at that, right? Oops. $7.50. Oh, here we go. Okay, so there we go, right? We get exposure. We are basically long the call. So if we just look at it like this, guys, right? Let me just hide that over there. We're long the call, but for a much cheaper price, right? We only start, losing money, I guess, when we start pushing back over after $27. So this is a 1-3-2 that we can structure that, takes similar position to a call, but we get a better risk reward scenario.
Exactly. And I think Jordan said something before that, it really gets you thinking about why this is such a good structure. Because when you're buying just the call, let's say you think that it's going to go up. Do you think it's going to go up by 100%? Probably not. But you want to take that view on it moving upwards. When you just buy the call, you pay, if you look at your payoff graph, it goes all the way up.
Mm-hmm.
What that tells you is that you're paying for the possibility of it going to those prices. So we sell off some of those. And, yes, we have a smaller range, but it's a more realistic range too. And we're not overpaying for the option anymore because we're not paying for all this could be situations that we don't actually want a view on. So the more specific a view that you want to take in the market, the better you can use the option chain, right? So you want to have a view on how long until your view comes to view. Like if you think it's going to go up 10%, it's okay, so you have a price target, right? So now you can structure your fly around that price target. You should have a timeline, right? And you should know how quickly you think it's going to move.
Mm-hmm. Yep.
So why don't we go over our TWO trade, Jordan? Because I think
It's a great one.
it was a really good trade. And it really goes to show people how we need to be on the lookout for market inefficiencies. Because when you really start looking at trading from that perspective, there's stuff everywhere. And when you start trading on those things, all of a sudden your expected value goes up like crazy.
So last night or yesterday afternoon, TWO implied volatility was over 200%. And we thought that, the forecast is only going to be about 110%. So what we decided to do is say, you know what, options are too expensive here. And it wasn't just that implied was higher than realized. It was that we went on StockTwits and we could see people buying this thing like crazy, right? Let's just head over to StockTwits right now. It was like the amount of watchers for this stock was basically the whole option volume for the day. Right? I think it traded like maybe 15,000. We had 6,000 watchers, and people were just saying buying calls on TWO. So they were driving up the price of these calls. And actually, guys, this skew yesterday was a lot higher on the call side. So what we did was we sold the $7 calls, and we hedged with the underlying shares to capture a really nice trade here. So I'll actually go and price it on Thinkorswim what we had on yesterday.
Yeah, so we closed it out today for about 30% or so.
Yeah, that was a very good trade. So
and it was pretty like high conviction trade.
Yeah, it was. It was a very high conviction trade. So these calls, guys, yesterday were going for 95 cents. 95 cents. The stock is only down 70 or 60 cents from when we sold it, and the options are down 70 cents. So what we did was we sold these for 95 cents yesterday. So here is what our position looked like. Okay, we get rid of that. Okay, this is what it was, and we didn't. As you can see, we have basically a big directional bias to the downside, and we didn't want that, right? We want to kind of hedge out our short deltas exposure. So what we did was we bought some of the shares to put on a trade that looked 605, perfect. So to put on a trade that looked just like this. This was our position yesterday and going into today. This is what it looked like. And obviously this morning, stock only dropped a few cents, and options got crushed because volatility was just too expensive. And it was a great trade. We made some good money here.
You remember that NKLA trade we were looking at?
Yeah.
Is that still on the table?
I don't. No, I don't think so.
Do you want to talk about it then?
Yeah, it's just because you can't short the shares.
Mm-hmm.
Unfortunately.
Yeah. So, and guys, if you can figure out how to make this trade work that we're going to show you right now, you can dump your whole account into it and make like 6%.
Yeah.
Not financial advice, but
yeah, if you can find the shares to short. So yesterday, the going rate for at least on Interactive Brokers was 148%. I want to say for NKLA. So to borrow the shares. So if you want to short the shares, you got to pay 148%. But embedded in these options was a 280% borrow cost. So what you could have done is, so you guys see here for the $70 call and put, you see how it's $8.60, but basically $9 for the 70 call, and it's $15 for the 70 put, right? That huge spread is because there's a borrow cost embedded in those puts. So if you can do something like this, so we're going to create a synthetic share. So we're going to sell this. It's going to be called, we're going to sell the put here.
Yeah, this was juicy. It was basically an ARB. Yeah, it was free money.
It is an ARB. It is an ARB, but you can't borrow the shares, which I think is why it's so drastic. Okay, so then you could buy. So you sell that put, you buy the same strike call. Okay, so check this out. We have created a stock, synthetic stock. Right? Looks just like a stock P&L. If it goes up, you make money. If it goes down, you lose money. Now, we are collecting $5 for this trade, right? We're paying $9.70 for the call, and we're paying $14, and we're receiving $14 for the puts. So if we go in short shares now, we go and short all these shares. So we'll just do a one lot for the sake of this. Right? If we do that, we get an arbitrage. You can see $534 right there. Now, of that $534, you're going to have to pay back to borrow those shares a little bit. But it's going to overall, you're going to be able to make more money from receiving that extra credit on the put side.
Do you guys see what's happened here? Like, this is epic. It's free money. If you guys can get the short shares, it's free money.
Yeah. If you can get the short shares, it's free money. Because embedded in this is, let's see here. Let's do a quick
Look at that risk profile.
Yeah, it's flat.
If the stock goes to 5,000, you make your $500. If it goes to $1, you make your $500.
So this is actually
literally amazing.
50 divided by 70. Right, so you're making 7.8% this week, and you have to pay back some of that from borrowing the short shares, but it's nowhere close to 7%.
There you go, guys. There's an ARB for you. Drop a like on the video for the ARB. Come on.
Yeah, but
ARB.
You can't find the short shares, that's for sure. Maybe you could. I don't know. Maybe you could. If you find a brokerage that can do it, go for it.
Yeah, Warren put the mind exploding emoji. And that's really what it is, man. Like that's cool stuff.
Mm-hmm.
It sucked that we couldn't short the shares this morning, though.
Yeah, I know. Or yesterday morning.
Or yesterday, yeah. But if you guys can figure it out,
yeah, let us know. Let us know which brokerage is allowing you to borrow shares.
Please,
yeah.
And yeah, Warren, it's definitely not Interactive Brokers, so sorry, man.
Yeah. But other than that, anything else you want to chat about, Sean?
No, I don't think so. Overall, what do you think's going on with airlines, man? Why do you think they've been so all over the place?
You know what, dude? It's the whole market's been on a rally, and obviously they got banged up the most, so they're gonna come back strong. And it's in the news a lot, so that's putting more retail traders into it. Putting a lot of money's flowing into it for sure, and that's what's causing these
all the
huge
volatility.
Rallies.
Yeah, guys, it's absolutely wild. Like, I don't even know how to think about this market, but the volatility is good for our pocket, for our bottom line, which is okay. That's the beauty of option trading, man. Like, it's like there's just so many ways to skin the cat. You know what I mean?
Yeah, definitely.
Yeah, guys, if you have any trade ideas that you want me to take a look at, you can send me a message at sean@predictingalpha.com. I'll type that into the chat box here. If you guys have any questions, we can definitely have a chat about it. And but if that's it, we're probably gonna wrap up the live there. We just wanted to come on, break down a couple trades. That ARB was one that I really wanted to share with you guys. That was such a cool thing that we were able to come across. So yeah, if you guys end up getting that ARB on, also send me an email. I'd love to know how that goes for you.
Yeah.
And where you got your fills. Okay, guys, take it easy.